American mortgage rates just hit a near 25-year high. What are 7.5% mortgages doing to America? Last week, mortgage rates hit 7.48%, up over a third from a year ago, and the highest since Matchbox 20 dominated the charts. As CNBC put it, this is, quote, crushing affordability for potential home buyers.
Mortgage rates are at their highest level in 20 years with housing prices still high. That means buying a new home is getting even more expensive.
I mentioned in a recent video how homeowners are stuck because if they sell, they have to rebuy with a mortgage that costs double or more. So yes, the house they own went up, but the new house would cost even more. You got to live somewhere. Well, maybe not in California where these streets are paved in RVs, but still. To put it in raw numbers, in mid-2020, mortgage rates were 2.88% and the median house was $323,000, meaning a mortgage with 10% down would cost you $1,200 a month. Now, with 7.5% mortgages and the median house at $416,000, that would cost you $2,600 a month for the median house. This lock-in is inconvenient for empty nesters hoping to downsize and free up the house. Of course, it's also exacerbating the housing shortage for families, with housing inventory now a massive 46% below the historical average. But it is catastrophic for young couples who can't move out of their one bedroom to even start a family if they'll be putting half their salary on the mortgage. What's driving mortgages higher fundamentally is bond prices. After all, borrowed money is the key ingredient in a mortgage. So if bond prices are rising, mortgages are rising almost in lockstep. And bonds are high because markets expect interest rates to stay higher for longer. Because the economy refuses to die despite the Fed's best attempts. As CNBC put it, quote, investors just aren't seeing the kind of deterioration that they expected. Meanwhile, as I've been mentioning in videos, underlying core inflation has been stuck all year, laughing at Jerome Powell's puny attempts to pretend to take away the punch bowl. Facing these odds, buyers are now flocking to cheaper adjustable rate mortgages whose share jumped 3.5 times since 2020. Remember, those were the mortgages that caused the trouble in 2008 because they spiked. Adjustables dull the pain for now, but it also means that if the Fed keeps hiking, or say if they adopt that 3% inflation target, then those mortgages could climb towards $3,000 a month. Finally, all of this is hitting rents, which is the main alternative to owning a house. In 2020, the average asking rent in the US was $1,600 a month. It has now crossed $2,000. That's in 3 years. 25%. That would be about half the income for a working class family, even with 2 workers, and it's obviously out of reach for the young who must double up or do without. So what's next? Don't expect much relief on mortgages. Bond prices are saying it'll be years before we see cheap mortgages again. And while home prices are leveling off or falling in the less popular cities, that is starting to turn up again for the cities people want to move to. At some point, stuck families will bite the bullet and do what they got to do, cutting back on other spending to feed a very hungry mortgage, courtesy of the Fed. Okay, we'll be watching. See you next time.